All right, let's cut right through the noise. Forget all the hype. We are diving straight into the raw data to decode the institutional playbook for AMC. Seriously, this isn't about speculation. It's about following the money. Let's get right into it.
Forget the headlines, forget the forum chatter for a second. The market, it leaves fingerprints. And right now, those fingerprints are pointing to a massive divergence in AMC. You see, the numbers are telling a story that the price action just isn't. So let's follow them.
Okay, our investigation starts right here. 74.46%. That's the percentage of all AMC shares traded today that happened off the public exchanges. Now, this isn't just a high number, it's a huge market anomaly that demands we look a whole lot closer.
And context, as always, is everything. A high number is one thing, but look at this. It's a significant jump from the norm. We're talking more than 4% over the 30-day average. This isn't just market noise, folks. It's a clear signal that institutional activity is accelerating. The real question is, why are they operating in the shadows?
So what does this signal actually mean? To really get the why, we first have to understand the how. So let's break down the mechanics of what this off-exchange trading is all about. This is where the big money operates. These off-exchange venues, you've probably heard them called dark pools, they're not some grand conspiracy. They're actually a structural part of modern markets. They exist so that large institutions can move massive blocks of shares without causing these huge price swings on the public or lit markets.
I mean, just look at the scale here. Let it sink in. 3 out of every 4 AMC shares that traded hands today did so in the dark. Only a tiny fraction of the total volume was actually visible to the public in real time. This is where the institutional game is being played.
Now for the next key piece of the puzzle. This hidden volume, it's only half of the equation. The other half is the immense pressure that's building on the other side of this trade, the short interest.
And just for a quick refresher, short interest is a direct measure of bearish sentiment. It's basically a bet that the stock's price is going to go down. But, and this is crucial, it's also a measure of future buying pressure because every single one of those shorted shares must eventually be bought back.
And here is the official number. 24.22%. That's the percentage of AMC's entire float, the pool of shares available for public trading, that is reported as sold short. Let me be perfectly clear. In any market context, that is an extremely high figure. It's a massive quantifiable bet that the price is headed down. Now, let's translate that percentage into raw numbers, because it's staggering. We're talking about nearly 112 million shares. That is an incredible amount of obligated future buying, just sitting there on the books, waiting for some kind of catalyst to ignite it. So, let's put the pieces together. We have massive hidden volume on one side and extremely high short interest on the other. Now let's connect these dots and try to map out the potential playbook that the smart money is running. This is the critical question, right? Why do all of this in the dark? What's the strategic advantage for these institutions to hide this level of activity from the public market?
Well, the reasons are structural and not necessarily nefarious. They use dark pools to minimize their own price impact when they're buying or selling huge amounts. It allows them to, say, accumulate a large position without tipping their hand and sending the price soaring, or distribute a position without crashing it. It's also really essential for hedging complex option strategies. It's all about execution efficiency.
Okay, so with all the evidence on the table, we can now construct 2 competing data-driven theories. This isn't about predicting the future. It's about understanding the probabilities of the setup we're seeing right now.
So how do we interpret all this? The data is pointing in 2 completely different directions. Let's look at the bull case. That 24% short interest, it's a coiled spring. If this massive dark pool volume is actually institutional accumulation, well, that could be the fuel for a massive squeeze. Now, the bear case, that same volume could be institutions quietly selling their massive positions without tanking the price. You add in the negative online sentiment and the company's fundamental debt, and you've got a recipe for a significant drop. And this, right here, is the most important takeaway. The numbers show a powerful divergence, a conflict between positioning and price that suggests high volatility is probable. But it does not guarantee a direction. The setup is explosive for sure, but it could resolve either way. So what's the play? What do you do with this? You don't guess. You watch the data flows. The strategy here has to be to remain data-dependent and just be acutely aware of the risk on both sides. Your decisions have to be driven by the data, not by hope.
And in a setup this tense, that's really the only way to navigate it. Stay disciplined, stay liquid.
And please, everyone, remember, this analysis is for educational purposes only. It's based on data that is current as of this recording, and this stuff changes rapidly. You should always perform your own due diligence before making any investment decisions.
We are tracking these flows in real time. While you analyze the next move, go ahead and check out the tools in the description. You can sign up for Public to get $20 in free assets, check out Webull for that BTC promo, or look into NVDA on Moomoo. All the links are down below. And hey, like and subscribe for more deep dive analysis.